Joe Biden will unleash accelerated stagflation. Martin North, John Adams, in the interest of the people. Hi, John.
Hi, mate. How you going?
Not too bad, yourself?
Pretty good. I'm recording today from Sydney.
Yes, indeed. Well, we've got a few issues with COVID in the local area around here in down south, as it were, and so it's probably more convenient to make this recording virtually. And it's a very important conversation today because, of course, the big discussion we often have is inflation, deflation, which way is it going to turn out? And as you highlight from the title, Biden coming in has changed the game a bit, hasn't it?
Yes, yes. So we obviously have had this inflation deflation debate raging on for the last couple of years, and you and I had butted heads a couple of times in 2020. Now, a couple of points to make. The first one is that we did do a show in June in which I said house prices will not collapse within the next 18 months. So far, so good on that prediction. Then I started to say we're going to start to see stagflation. And we did a number of shows last year where I said, well, just to recap, what is stagflation? It is low economic growth, high unemployment, and rising prices. Stagflation happened in the 1970s in Australia, as well as in the United States and across the world. And stagflation is a conundrum for mainstream Keynesian economists because if we have high unemployment, Keynesian economists say this is because of a lack of aggregate demand. If you have a lack of aggregate demand, if demand falls, prices should fall. So when prices rise, when unemployment's rising, that doesn't fit the whole John Maynard Keynes theorem, and that really presented a huge problem for academic economists in the 1970s, and I think we're going to start to see that again. So one of the key points of evidence I cited with our show last year about Australia is that we saw a couple of quarters of negative economic growth. We obviously saw the rise in unemployment as the lockdowns were implemented across the country. And we also saw this explosion in the money supply measured in the annualized growth rate in terms of broad money. And I said, when you combine those three, that's going to be the recipe for stagflation. Now, this week, I've published a new article on my website, adamseconomics.com, and we can put that up on the screen for people to see. And now I'm coming out and saying we're going to see what I call accelerated stagflation, which is the stagflation process actually getting faster. And there's a number of key things that Joe Biden has announced even in the first 3 weeks of taking office that I think is going to accelerate this process. And obviously, as stagflation gets faster, this is going to have huge implications for our viewers and millions of people across the world.
Yeah, and I guess it's just worth pausing to say it also depends on how you measure it, right? Because there is a theory, I think probably right, that the official measure of inflation is probably significantly understated, and the underlying inflation that's really going on is probably significantly higher than the official figures would want to admit.
Yes. Look at so you and I have spoken repeatedly about the manipulation, the corruption of the CPI, the Consumer Price Index. There's been a series of methodological changes both to the American CPI and the Australian CPI. And one of the big things that happened in Australia, just to recap for our audience if they are hearing this for the first time, in 1998, the CPI was changed by removing land from the CPI. So this house price bubble in large part has been a bubble in land prices that has not been captured in the Consumer Price Index. There was a review in 1998 under the Howard government. And obviously the key historical fact is who put in the submission calling for the removal of land from the CPI? None other than our key nemesis, the Reserve Bank of Australia. So the RBA has been responsible for blowing up this bubble through extraordinary monetary policy, to taking interest rates down to zero, to quantitative easing, to providing banks with cheap in terms of cheap capital, in terms of printing money out of nothing and giving them a low interest rate, cheaper than the wholesale market. and all of this has been designed to blow up the bubble. And then as the bubble has gotten out of control, their whole modus operandi at the moment is to keep the bubble intact. And that was all what was that was all 2020 that was all about. Now, the other point I just wanted to make, Martin, just before we started talking about Biden, is one of the key points that we cited last year that was going to confirm that the stagflation process was going to take place and go underway was the announcement of, in terms of unlimited quantitative easing. I mean, we saw some big announcements last year. We saw, for example, the RBA around September, October, calling on state governments to take on or to inject $40 billion of new infrastructure spending, and they're going to finance that through QE by the RBA. That was obviously going to fuel inflation by more money printing and injecting that money into the real economy. And what we've seen, the Reserve Bank of New Zealand and the Bank of England cut rates, commit to more QE in terms of their programs as well. And obviously, when you look at the US Federal Reserve balance sheet, by August of 2019, before the repo crisis, the balance sheet shrank from $4.5 trillion to 3.8, and now we're sitting at about 7.4. So both with the repo crisis and with COVID-19, the Trump administration effectively doubled the size of the balance sheet of the US Federal Reserve. And now we are seeing some very big new commitments by the Biden administration, which I think is going to take the balance sheet to even a larger figure than where we are today. So the first thing I want to articulate is that the Biden administration, so first off is Trump came into power with federal US government debt at around, I think, $18.5 trillion inherited by Obama. He left office with debt at almost close to $27 trillion in terms of federal debt. Now, and obviously with a huge structural deficit coming in with a big recession. So Biden's come in, and rather than trying to address the deficit, the first thing he and Yellen and Janet Yellen, the former chairwoman of the Federal Reserve, who's now the Treasury Secretary, have come out of the bat with a new $1.9 trillion stimulus COVID relief package. That last week passed the US Senate. To the best of my knowledge, and Martin, happy for you to correct me, I don't think it's passed the House of Representatives yet.
Nope.
But it is, well, given that the Democrats are in control, that's well on its way to passing. And that's obviously a huge injection of money. On top of that, the Biden administration has announced a $2 trillion climate change action package, which is focusing on reducing emissions, clean energy, and improving infrastructure. And that's $2 trillion over 4 years. So with a huge structural deficit, with a weak economy, we've had effectively a commitment of $4 trillion worth of new spending, which they'll have to issue new bonds into the market, and what they need to do in order to keep so when you have extraordinary amount of government debt, the biggest concern for governments is the interest costs in terms of that debt, because if the interest costs get too high and you can't roll over the debt, well then you get solvency issues in terms of that government. And some governments, like, for example, the Lebanese government at the moment is actually, they're actually struggling with that because they don't have the ability to print their Lebanese pound to infinitum like the Americans do. So now in the last couple of weeks, we have seen some rising interest rate yields in the 10 and the 30-year bonds in the US. And as they issue $4 trillion of worth of new bonds and trying to roll over their existing debt, the modus operandi is to keep these interest rates low. And how do they do that? They need to keep bond prices high, and they do that by printing extraordinary sums of new money, expanding the balance sheet, and buying bonds at artificially higher prices. So that's the first piece of evidence that I would say that is which means that we're going to see an acceleration of the stagflation process. The other key piece of evidence I point to is that the Biden administration has come in with a whole host of executive orders which have started to cost tens of thousands of jobs. So from re-signing the Paris Climate Accord, which means that carbon-based industry will have to reduce its emissions, which will result in job losses, to the stopping of the construction of the US-Mexican border wall, to stopping the construction of the Keystone XL pipeline, which is from Canada to Mexico, The other thing is that he's implemented an immediate prohibition on fracking on federal land, and that was employing a lot of people. So the oil and gas industry boomed under Trump, creating tens of thousands of jobs. So those jobs are now being, in terms of those jobs, are now being wound back. And it still hasn't been passed yet, but there is a proposal to raise the minimum wage in the United States to $15 an hour. And there have been some estimates by some economists who have said that that job, particularly among the working poor, is going to result in quite a few job losses as business switches from labor to automation in order to save on higher wages costs. So those policies, given what Biden inherited from Trump, I think the additional stimulus at the fiscal monetary side, particularly at the federal level, at the same time of implementing a series of regulations and laws which are either going to ban certain types of economic activity, or if they're going to raise the cost of labor or business imports. And this is going to, I think, have a huge impact on employment, unemployment, and wages growth and jobs growth in America. At the same time, we're going to see a further explosion in the money supply, and that will lead to rising inflation coming forward in the United States.
I think it also depends, John, as to where that money goes, right? So I agree that the money supply has definitely increased. How much of that flows back into the financial system and the financial markets and blows up effectively stock prices and other financial instruments? How much goes back into the real economy and the implications there? I mean, those are all questions which we'll have to watch and see, I guess. But certainly the figures are eye-wateringly large, and you'd have to say that amount of liquidity that's been created one way or another is going to go somewhere.
Yes, so that you and I agree with. Now, the one thing I will say is that we have started to see, so when you print a lot of money, you start to see bubbles popping up all over the place. And you are correct. I mean, we're seeing the stock market at a record high. We're seeing Bitcoin at a record high. Gold and silver went up quite a bit last year in percentage terms, both in American dollar terms as well as Australian dollar terms. You see fine art and a whole bunch of other sort of assets going up in price, and that is obviously being fueled by all this money printing. So we are seeing some signs of at least asset price inflation. Now, in terms of real economy inflation, what I would point to is that in the last perhaps 3-4 weeks, we are starting to see signs of money moving towards commodities. And typically, how this inflation process starts to occur is, so it starts to go into in terms of primary producers, in terms of primary products. And so if people look at the price of oil, I think the price of oil today is the highest since the start of the pandemic. So in the last, I think, couple of weeks, the price of oil has gone up about 10%. If you look at non-energy commodity prices like food, so if you look at corn, wheat, rice, etc., you're starting to see, even in terms of the US, like lumber, in terms of wood, the prices of inputs are going up in terms of some of these commodity markets. We are starting to see a rising amount of inflation expectations. So there's a whole rich body of literature in the economic fraternity about the importance of expectations and setting in terms of inflation. So if people expect prices to go up fast next year, whether they'll actually put up their prices consistent with those expectations. So the United States measures inflation expectations as well as does New Zealand. And in both cases, they have seen a remarkable like a material increase in expectations relative to, say, 12 months ago. So and then the other thing is that typically in a stagflation environment, because the real return on government bonds tend to be reduced, you do see some money flowing out of government bonds into other assets. And the way you pick up whether there's a flow out of money from bonds is by looking at the yields on bonds. And we just mentioned before that the 10-year and 30-year yield in the last maybe week and a half, 2 weeks in the US, the bond yields have been rising, which is again another another contradictory sort of statement relative to Steve Van Meter, who thought that bond prices will continue to go higher and yields go lower. But no, we're starting to see a bit of a reversal, and we'll have to see if the central bank steps in to put a cap on rising bond yields. But I think when you put a bunch of those factors together, we are starting to see again some of the early signs of this inflation problem seeping into the real economy. But I agree with you that it does take time for some of these things to flow through, but we are starting to see some of the beginning signs.
Yeah, and I'd also add, of course, John, the central banks are now targeting inflation differently in terms of they're saying they want to see, inflation well advanced before they start changing their monetary policies, unlike previously where they might have reacted sooner. So that might be another plank in the argument to suggest that we are going to see more inflation rather than less.
Yes, I mean, look, that's definitely an important point. So the Federal Market Open Committee, the FOMC, said last year that they have what they call a symmetrical inflation target. So before inflation was not supposed to go above 2%. Then they said, well, it needs to average out at 2%. So they basically said we had a number of years where inflation was below 2%. So we're happy for inflation to run above 2% for a number of years, so that the long-term average is 2%. So so there definitely has been, there has been some shifting by the central banks, and in terms of what they're allowing inflation to happen. And the reality is something that you and I have consistently said throughout 2020 is once you start this process of extraordinary monetary policy, you can't reverse it, because if you start to raise interest rates, that's going to lift interest costs on a whole host of people who have significant amounts of debts across the Australian economy and across the world, but also in terms of quantitative easing. If you switch to quantitative tightening, which means you're going to start selling these bonds at prices that are typically below what you bought them, because with quantitative easing, you buy bonds at artificially high prices, or the private sector is not willing to buy those bonds at the same price. So what that means is the bond prices will go down and the interest rates on the bonds will go up.
But there are some interesting parallels perhaps with the 70s.
Yeah, that is a very good question, Martin, about the 1970s. So so I've written in my article this week that there is a historical parallel with the 1970s. So if you look at the data, stagflation in the 1970s started under Richard Nixon. It continued under Gerald Ford, and he left office in January of 1977. And then the process of stagflation started to become faster under Jimmy Carter, and you can tell that by the rate of inflation going from about, I think, 5% all the way up to about 14% by 1980. And so, while interest rates, the amount. So a couple of points to make here. The first thing is that when you cut interest rates, that does take some time to flow through, and so. In the case of Jimmy Carter, the interest rate cuts actually happened under Nixon and Ford to a dramatic extent, where the interest rates went from, I think, 13% all the way down to about 4.75%. But that started to flow through into the Carter administration. But what did Carter do was he continued to run huge deficits over his 4 years. So what I would say is that the interest rate cuts and the extraordinary monetary policy that we saw in 2020, that's going to carry on into 2021 and beyond. But I would say that the additional monetary policy and fiscal policy that we talked about earlier, that's going to quicken the process. And so I think we're going to start to see rising inflation in a very similar way that happened under Carter. But in reality, if you look at the data, it actually happened under Republicans, and it got faster when the Democratic president came in. And I think that the evidence so far points to a very similar phenomena happening over the next 4 years.
Cool. Well, of course, the thing that happened in the 70s was the very significant oil shock as well, which was another fundamental reason why the economy was disrupted. But I think it's still worth reflecting on what happens if rates do rise.
Yes. Now you look at, so you're absolutely correct that the oil shock led to a significant rise in price, And before the OPEC wars, I mean, basically, kind of like how we've talked about certain commodity markets being, the price being fixed by, agreements or manipulation. The price was manipulated higher, and that obviously had a huge shock in terms of the input cost for Western economies. Now, the only point I'll make is that while so far we haven't seen any attempts to restrict oil supply in 2021, as the price goes up, we will start to see those prices flow through to industry as well as to people, people getting petrol at the bowser. If you think about what happened with oil before the GFC, oil got up to about $150 a barrel, and petrol was almost $2 a barrel, $2 a litre in terms of Australia. So, so I think according to my notes, oil is around $57 a barrel, roughly around now. If this inflationary process starts to continue going forward, we could well see oil prices at $100 or $150 a barrel, and that will flow through to the economy. And even though it's not driven by a restriction in oil supply, the higher price is going to definitely lead to an increase in inflation, even by the standards of the ABS and how it's measured by the CPI.
Absolutely. Well, the oil is going to be a very important thing to watch. Of course, the US is a net exporter of oil now, which is a big change. But nevertheless, as far as Australia is concerned, we have to import our oil, and that will transfer quite directly into higher prices. So what are the broader implications then of this, both for the global economy and the local economy, John?
Sure. So I mean, look, in this conversation, we've largely talked about what's happening with the United States, and obviously, sometimes people say, well, how does the US how does it affect here in terms of Australia? So I would say, so the first thing is that when you think about global interest rates, I mean, the United States being the center of the financial system, that definitely has a huge impact. So if we start to continue to see rising yields, or if we see yield curve control, and that yield curve control is a specific policy where they try to target the interest rate on bonds at a certain level. If we start to see some of that impact, that's going to have impact on global interest rates. It's going to impact the decisions of other central banks, including our own, and that will start to flow through into what banks may pay in terms of credit on the global market, and obviously flow through into exchange rate settings and in terms of what interest rates we may have here in Australia. So I think that's probably in terms of the first point. The second point is that as the price of oil rises, because Australia is reliant on oil, because we are an oil importer, the price of oil, that definitely will have an impact in terms of the cost in terms of the economy for households, but in terms of business, and anything else that we are importing that are determined by a global commodity market, rising prices across the board, that will have an inflationary impact. But I should say there could be a positive impact in the sense that as commodity prices, for example, like iron ore, if that does increase, well, our terms of trade could increase, and that could actually be a benefit for the trade surplus. So there are some instances where rising prices in commodities may help certain sectors in the economy. It may actually create additional jobs. But on the other hand, if you're in the non-mining sector, in say parts of New South Wales and Victoria in particular, that stagflation could be a huge impost in terms of people's families' budgets. So I think they're the things that are how the US could impact in terms of Australia. But I should make the point, and we made this point at the beginning of the conversation, we started off talking about last year and said that the Australian data, even before Biden came in, was pointing towards Australia going through stagflation. And I think that now Biden's coming in, and some of these other decisions being made around the world by other banks and central banks, by governments and central banks, we're going to start to see this stagflation process quicken around the world. And for those Australians who haven't prepared appropriately, they're going to be their household budgets are going to be squeezed quite a bit as the inflation comes through, and if wages don't keep up in terms of it doesn't keep up in terms of prices. One last point I will make is that, and obviously not to be too critical, Harry Dent has now come out in a new interview and talked about the deflation crash that he's been predicting for a while, and he's moved the goalpost again. So I think last year he may have appeared on Walk the World with you and talk about something happening in the second half of 2020. Then it moved on to the first quarter of 2021. Now I think in the latest interview he's given on American TV, he's talking about the second quarter of 2021. The key premise of the conversation you and I are having here, and what Harry Dent and others are talking about, it comes down to what happens with this debt bubble. Can they continue to expand it through money printing and more stimulus and more federal spending, or will it shrink? Will you start to see defaults? And this all goes back to an interview that we did with Harry Dent back in 2018, where I asked point blank about what's going to stop. I asked Harry Dent what's going to stop the central banks from printing 50 trillion, 100 trillion, whatever they need to stop the debt bubble from imploding. And Harry's assumption back in 2018 was that there will be political opposition to the central banks in terms of their money printing campaign, and that opposition will put a limit on what the central banks can do. And from there, that's how the debt bubble unravels. Well, all I can say is, so far, I see no evidence that the central banks have been limited in terms of their mandate, their political or legal mandate, or their economic mandate to print and to protect this debt bubble. The other point I'll make is that we are seeing this new phenomena of central bank officials now becoming politicians. And so Janet Yellen moving from the US Federal Reserve now being the Treasury Secretary. And I haven't confirmed whether this has actually happened, Martin, and maybe you wish to comment on this, is Mario Draghi, the former head of the Italian Central Bank and then the ECB. He would put his hand up to be the Italian Prime Minister. I'm not sure if that's actually happened yet, but that's another indication of central bankers now saying, in order to solidify our power in terms of our political and economic power of printing and blowing up the biggest debt bubble in the history of the world, we now have to actually take over executive branches of government in order to ensure that that the right sort of policies can be put in place that are going to protect the debt bubble at all costs.
Well, it's true. I think that more and more coordinated thinking from central bankers is cascading down into the political world, and it manifests itself in two directions. One is where, as you say, people move into the executive branch rather than actually just in central banker land. The other is, of course, that central bankers are held less and less accountable for what's going on.
Sure. I mean, although what I will say about accountability is, so I would say that everyone in the elites is being held less accountable today than 20 years ago. So whether it's the politicians, whether it's the central bank or regulators, bureaucrats, including the media. There's a whole host of scandals where people should have been held to account or resigned for producing poor results. And so far, those people have retained their jobs, and there's no public outcry for people for people to resign and for people to move on.
Well, people should be watching the interests of the people, because at least we're calling it out and we're highlighting some of these crazy decisions that are being taken and the implications, which are quite profound and frankly quite worrying.
Sure. Martin, if I could, so I just want to wrap up this conversation, because I did get some criticism, I think, from one of our last shows, and one person said, what happened to the crash? I've been waiting for the crash. Now, going back to my 6 scenarios, basically, there's only 2 types of crashes that are really going to happen. Either the property market crashes or the dollar crashes. And the dollar crashes through inflation, or the property market crashes through deflation. And so a crash is happening as we speak. And the crash is actually in terms of the dollar, the Australian dollar, the US dollar, and whether you want to measure that against gold or silver or cryptocurrencies, or in terms of commodity prices, etc. We are seeing, with all this money printing, the dollar losing its value slowly but surely, and I think that process is going to quicken. So for those who have taken the Dent thesis and structure their portfolio in that way or in that manner, or people who follow sort of my point of view with Peter Schiff, who think we're going to have a stagflation problem and have structured their portfolio that way. The key question that everyone must ask themselves is, can the central banks protect the debt bubble? Because if they can, then we're going to have an inflation problem, and you should protect your portfolio in a particular fashion. And people can contact me and I can explain the best way to protect yourself against inflation. If you think that either because of a lack of capacity or because of some legal or political limit to what the central banks can do, and you think that we're going to have deflation because we can't continue to print at the scale that we're printing today, well then obviously that's more in line with the Dent thesis, and people should prepare their financial arrangements and their affairs consistent with that thesis. So all I would say in conclusion is a crash is occurring, and it may not be the crash that you're anticipating, but the key question is, do you prepare yourself for a property crash or a dollar crash? It all comes down to your assumption about what the power of the central banks and what they can get away with.
Yeah, I agree, John, with that. And the fact of the matter is, it's very hard to know for sure which of those two things are going to play out, right? Because both of those futures are still, I think, live. But, more evidence comes, we'll begin to actually get a better read. And you've certainly outlined some issues today. What I would say is it is very tough to try and actually manage a portfolio that is insulated on both scenarios. Right? So you almost have to back a scenario and say it's more likely to be X rather than Y, deflation or inflation, because it's very hard to protect yourself against inflation and deflation because by definition it pulls in opposite directions.
Correct.
Okay, John, appreciate that. Very interesting conversation, very important conversation, and we'll pick it up again down the track. Martin North, John Adams, in the Interest of People. We'll see you next time.